Boy, where do I start? I mean, first off, when you talk about averages for earnings growth, I mean, that really distorts the picture, doesn't it? You have to look at individual stocks. The stocks that I own, I'm very confident that they're going to have earnings that are greater than 1 to 2% growth over a year period. That's a blanket statement that really catches a lot of eyeballs, especially now when everybody is insecure about where the market is headed. That's easy to sink your teeth into. But I will tell you this. On an individual basis, there are many, many stocks that look very promising. Their valuations are good. The Fed funds futures market, all those things that are really distorting looking at the individual details. And I encourage your viewers to look at the individual details of stocks, and you will find some gold at that end of those rainbows.
Implicit in what you just said, Peter, is maybe a little hesitance about the overall market trend. In other words, if I have to be very particular and pick certain kinds of stocks, that feels like a little bit of faint praise for the market more broadly. Am I reading you right?
Well, maybe, but let me just add this. Certainly, the trade war, I mean, I'm not turning a blind eye to that. So what I'm talking about are the large multinationals. If you've got a short attention span, say an investment horizon of a year or so, I would stay away from those, obviously, right? Because we know that the trade war is going to continue. There is no end in sight. It's going to be protracted. All things that I thought, by the way, were going to play out anyway. Yeah. So that's the only hesitancy, is be more selective. You know, the days are gone when you just buy a S&P ETF and sit back and watch your profits.
All right, let me turn to Erik and get a rejoinder there. You are concerned about what you see in the economic data. You are concerned that stocks are fairly fully priced. Tell me why you feel that way and what I should do about it.
So we think there's a 1 in 3 probability that the U.S. slips into recession in the next 12 months. And that's a pretty high probability out there. It's a warning sign. You've got very low CEO confidence that collapsed in the fourth quarter of last year and has not rebounded. That has begat low CapEx spending throughout the year, which has then generated very poor manufacturing numbers across the globe. The global PMI in manufacturing is below 50 right now. The U.S. is just slightly above 50. I think the Fed is going to cut 25 basis points because all the markets expect it. And they need to do something to combat that negative kind of confidence channel that's coming through the CEOs. And I think that's largely because of trade. I think the path for a big booming equity market is pretty narrow. Stocks are very expensive. Earnings are under pressure because wages are rising faster than prices. And you have a reality where it's a very thin line. You need probably a trade resolution to actually occur for the market to really pop in the next year or so.
So how do you invest?
That doesn't seem very likely.
How do you invest, Erik, if you're cautious on the markets? Where do you put your money?
Well, this is where being a diversified multi-asset investor makes a lot of sense, right? I don't know what's going to happen in terms of the course of the economy over the next year. No one knows, actually. There's a lot of uncertainty. There's a lot of highly valued asset classes out there. I think the best strategy is to actually diversify your portfolio broadly. Stay close to your policy, to your investment plan. Don't deviate a lot from it. And hopefully that will ride out the storm better than making a precipitous decision that can only be right in a very narrow band of probability.